Hi, my name is Ben Shepard, and I'm the editor of Rukeyser's Wall Street. In the wake of the Great Recession, a lot of the previously high-flying solar power names have just been absolutely hammered, as there were legitimate concerns about how much interest there was going to be in new green energy projects and where the financing for those projects would come from. But in the name of economic stimulus and addressing global climate change concerns, a lot of governments are beginning to kick in more money, particularly for solar projects, with the U.S. and surprisingly China leading the way. One of my favorite plays on solar energy is Yingli Green Energy. Trades on the New York Stock Exchange under the ticker YGE. It's actually an ADR that packages 3 of the domestic Chinese shares into one ADR. Yingli is one of the top 3 cost leaders in silicon-based panel manufacture. The major reason for that is that it's a vertically integrated company. It buys polysilicon on the spot markets, shapes that into its own ingots, then shaves the silicon down for use into solar panels. Unlike a lot of its competitors that have really been hammered by the nosedive in polysilicon prices, Yingli's actually benefited. What happened is back in the day when polysilicon had gotten up to $450 per kilogram, a lot of these guys just saw that price, or just forecast that that price was going to continue to rise. So they were locking in long-term supply contracts at these astronomically high prices. Yingli, on the other hand, though it took a lot of criticism for the decision at the time, never committed to any long-term contracts. It buys its polysilicon on the spot market, so it's now benefiting from the rock bottom prices. Another factor that's going to work in its favor long-term is the recent construction of its own silicon production facility. Construction is expected to be completed in the 4th quarter of this year, with production ramping up early in 2010. So again, that's just going to take it another step towards solidifying its cost leader position. Right now it has about 400 megawatts of production capability. It expects to take that up to about 600 megawatts next year, largely in anticipation of more Chinese spending on solar energy. They just recently contracted out the major project in Inner Mongolia, which has raised a lot of eyebrows. And China's also said that it's going to begin introducing feed-in tariffs over the next 2 years on a region-by-region basis. So that feed-in tariff is essentially going to pay energy companies to produce solar energy. While a unified national policy would be preferable, still region by region, that's going to generate a lot of new demand in China for solar energy. Yingli's share price has been hammered over the past year, largely due to the fact that it has swung to a loss, with a loss of about 17 cents per share for full year 2009. So again, that's raised some cash flow concerns surrounding the company, but that's really largely unjustified. It has more than $1 billion in untapped borrowing capacity, so it's more than sufficiently funded to maintain operations. And it's actually expected to swing to earnings per share of about $1.17 next year. So right now this is a great opportunity to get in on the cheap in the solar company with long-term growth potential, both at home in the domestic Chinese market and abroad.